Welcome to It Depends, a sales tax podcast by TaxConnex. I'm your host, Brian Greer, joined by my colleague, Jeff Meggs, and we're super excited that you've joined us today. Sales and use tax can be confusing and overwhelming, but it doesn't have to be. Whether you work in an industry or a CPA firm, or just someone who wants to stay informed about the latest sales tax laws, we've got you covered. Periodically, we'll explore different aspects of sales tax. So whether you're a tax pro or a novice, in industry, school, or a practicing CPA, tune in and join us as we attempt to simplify the complexity of the sales tax world. This is It Depends, because with sales tax, there's rarely just one answer, and often that's our answer to many questions. It just depends.
Sales and use tax nexus, if you're not familiar with the term nexus, it really is simply a term that reflects a connection. So if I've got a connection, some attribute of my business that connects me to a specific jurisdiction, in this case a state, then that state can impose its taxing authority on my business. If you don't have nexus, if you don't have any type of a connection with the state can't impose their taxing requirements on you. So when we think of sales and use tax nexus, the requirements to comply with sales and use tax historically were based or predicated on a physical presence. That being something like an office, an employee, attending trade shows, having inventory, performing services, any type of physical visitation to a state, to a customer that is intended to enable a market in that jurisdiction could be a nexus creating activity. Those were the laws in place for the majority of time as it related to sales and use tax across all the states. And when I say a majority of the time, from 1967 to 2018, 50 years basically, we operated under this physical presence standard and test. But in 2018, a big change came, and it came in the form of economic nexus. It started in the state of South Dakota, who legislated an economic standard and basically required companies who have a certain level of revenue, in this case $100,000 in revenue during a 12-month period or a calendar year, or had 200 transactions in that same 12-month period. If you had either one of those scenarios, you would have established nexus for sales and use tax purposes in South Dakota, and South Dakota could require you to follow and comply with their sales and use tax laws. This was a relatively new phenomena. Most of the states had attempted different levels of trying to widen the cast of net to capture more taxpayers. But in doing so, South Dakota kind of forced a decision, and that decision went all the way up to the U.S. Supreme Court. And the Supreme Court ruled favorably on the part of South Dakota and said that it was constitutional that South Dakota could impose an economic nexus standard on taxpayers. We refer to this as the Wayfair decision because Wayfair was kind of the big landmark case that sort of set in place this standard. Wayfair being an online retailer, they sell a lot of home goods. You're probably familiar with them. South Dakota asserted economic nexus against that taxpayer, and Wayfair fought it. It went up through the state court systems, and interestingly, the state of South Dakota's own Supreme Court ruled in favor of Wayfair. They actually ruled their own legislation unconstitutional. But South Dakota decided to take it up to the U.S. Supreme Court, and that's where the decision was ultimately made. This decision came out in June of 2018, and as you might have guessed or imagined, a lot of states sort of already had this pent-up demand and excitement around this standard. And so the legislatures of all the states started rolling out their own economic nexus standard. There are essentially 45 states plus the District of Columbia that have a sales and use tax The state of Alaska does not have a state-level sales tax, but they do have local administrated sales taxes. Those two have complied and formed an economic nexus principle in the state of Alaska for those locals. So today, the way I would leave it with you is if you've got $100,000 in revenue in any given state during a 12-month period, you need to be asking the question, have I established nexus in that state? And if the answer to that question is yes, then you have to understand you may have a tax compliance obligation in that state. By having nexus or triggering nexus or meeting that nexus threshold, that doesn't necessarily mean that you have a sales tax issue. It doesn't even mean you have a sales tax responsibility, or even that you might even have to comply or register for sales tax purposes. It simply means that the state has authority to impose its taxing laws on the business activities. So what we then shift to is an analysis of taxability. So in the event we have triggered nexus in a given state, we then ask the question, do our products and services, are those subject to that state's sales and use tax? Or potentially, do I sell to a company's type, maybe a nonprofit, maybe a governmental agency, that qualifies as exempt from sales and use tax in that state? Those are some of the questions you then need to ask and try to identify the answers to. When I described the economic nexus standard and I kind of gave you that $100,000 threshold, that's sort of the standard to kind of keep in your back pocket. However, you will find that there's different thresholds in different states. California and Texas have a $500,000 threshold. Mississippi and Alabama have a $250,000 threshold. But the overwhelming majority of the rest of the states utilize a $100,000 threshold. New York is another one that has a $500,000 threshold, along with transaction requirements. So while we have some consistency, broad consistency across the states, there's definitely differences on the nexus side. And like nexus, there's differences in taxability. The standard is that tangible personal property, the retail sale of which, is generally going to be subject to state and maybe local sales and use taxes. But services are all over the board in terms of tax treatment. We have sort of a general principle, and I think most companies recognize this, that most services generally are excluded from sales and use taxes. But the fact that that exists, the fact that I even made that statement, is what creates most of the risk for companies. And what I mean by that is we're all accustomed to operating in our home state. And a lot of companies start growing in their home state. They start to get familiar with their home state sales tax laws. They apply those laws to their invoicing. They set up their billing systems accordingly. And then they start to expand. Their customer base becomes more broad. They start to enter into additional states. Maybe initially they haven't triggered nexus yet, but eventually they do. Meanwhile, they've kind of lost sight of the taxability side of the equation. They have this impression they may have set up their tax system to operate efficiently and effectively, but they've really not recognized the fact that a lot of states have different tax treatment for different types of services. It's fairly consistent when we're talking about professional services. And when I say professional services, I mean there's 5 particular things that fit into that category. There's accountants, there's lawyers, there's engineers, there's architects, and there's medical service. Those are what I consider professional services. Anything outside of that, consultative, installation services, delivery services, all of those have the potential to be subject to sales tax in a given state. So it's a cautionary tale that once you start to grow and your business start to expand, particularly in today's environment, from a revenue perspective, you can find yourself fairly quickly involved in having to manage to certain sales and use tax laws across the country. The last piece of this taxability question, or equation rather, is situsing. This really just serves to identify where is the tax due, where is the transaction considered to be taxable, and usually that's a fairly clear answer. Typically, we address an interstate transaction, such as a transaction between a Georgia vendor and a Colorado customer, where the Georgia vendor is shipping tangible personal property via common carrier. That's going to generally be a destination-based citing, meaning the Colorado sales or use tax would apply to that transaction. When we get into services, that starts to get a little bit more ambiguous to some degree, particularly when you're dealing with technology. SaaS, software as a service, is a great example of this. I may invoice a customer in New York City for 100 seat licenses for a SaaS product, a cloud-based software service. So they've got 100 logins. And what I don't know, and what we may not be able to manage easily, is the fact that those 100 seats are spread out all over the United States. So in any one of those seats, in any one of those states, that service might be exempt. It may not be taxable, that software, whereas in New York, it is taxable. So how do you apply the tax to that transaction? Generally, when we're dealing with tangible personal property, it's the ship-to address. That's primarily when we're talking about interstate transactions. Sometimes on an intrastate transaction, depending on the state, even though it's shipped to another county or another city or another local jurisdiction within that same state, the local tax still reverts back to the vendor's location. That's some states. Some states are that way. Other states would say it depends on where you ship. So if you ship from, in our case, Atlanta, Georgia, where we're based, to Savannah, Georgia, we may have to charge Savannah tax or the county in which Savannah is located. So you have to identify and determine what the state laws are in each state relative to citing to get that right. So again, nexus is your first question. Do I have nexus? Second question, do I make taxable sales? Is my business engaged in taxable activities? If the answer to that is yes, then the following parts of this presentation will apply to you. I think we're going to roll right into a little bit of a discussion of when there is some level of exposure or risk that exists in a business. What do we do about that? So we've gone down this road of analyzing our nexus footprint, and we've determined that there is nexus in a number of states. I've determined there's some taxability in a number of states, and I've not been compliant. I haven't done anything. I haven't charged tax. I haven't collected tax. I haven't registered. Haven't been filing. What do I do about that? And there's a few options available to companies under those conditions and circumstances. One might be simply look at your business activities, confirm that you haven't charged any tax or sales tax to date, and you might decide, look, I don't know exactly what's going on in those prior periods, but I know I need to go ahead and do something sooner than later. You know, sales tax is predicated on voluntary compliance. While the states all have audit programs and auditors traveling back and forth across different states to target companies, they do not have the wherewithal to audit everybody. And so they're heavily reliant upon voluntary compliance. So it's in both the interest of the state and the interest of the taxpayer when you find yourself with nexus and taxable activities to get registered sooner than later so that you can begin acting as agent on behalf of that state, collecting and remitting that tax to the state. Now, sometimes there's some other factors. Maybe you started operating 6 months ago, or you triggered Nexus 6 months ago, as well as tax, and you started charging and collecting tax, and you failed to get registered to report that tax and pay it. Or there could be other extenuating circumstances. There could be that you're going through an acquisition and the buyer is, during due diligence, identifying these risks and these issues, and they're forcing you down a path of getting some of your prior period issues cleaned up. One way of doing that is to just register and file prior period returns. What that means is at the time you register, you tell the state that you had an obligation to comply at whatever date or point in time when you triggered Nexus and had taxability. So that might be December 1st of 2022. And what the state will do in reaction to that is simply give you notice that you have a filing obligation, probably a monthly filing obligation beginning with December January, February, March, April, all the way through to current. And so what will happen under those conditions is you'll actually file the returns, you'll pay the tax, you'll report the tax, and then you'll be assessed penalties and interest based on those periods that were delinquent. So there is a way to kind of manage through that to mitigate your tax liability and move forward. It's not a popular option. So register and filing prior period returns usually is a bit expensive. And when you really evaluate the overall cost benefit, it's probably not a valuable option. And I'll tell you why as I describe this third category or third option, voluntary disclosure agreements. We refer to these as VDAs in short. And the VDA programs exist in virtually every state. They're not always exactly the same, but they all have similar characteristics. It's basically a self-audit, and it's a self-disclosure of your sales tax liabilities for a period of time. And we call that the limited look-back period. That is usually the general statute of limitations of that specific state, which in most states is either 36 or 48 months. So what you're basically agreeing to do is come forward, tell the state when you had nexus, when you had taxable transactions, and agreeing to disclose all of those taxable transactions and actually pay or satisfy the sales tax that would have been due during those periods. This could be a company that actually charged and collected tax, or it just could be a company that failed to do any of that. They failed to charge, they failed to collect, they failed to register. And so either one of those scenarios are available in the voluntary disclosure process. The thing about taxes collected that I want to point out, though, is that if you've collected taxes beyond that limited look-back period, then you're not going to get protection in those periods. You're not going to get protected. You will have to disclose and pay any dollar that you collect, no matter how far back it goes that you collected that dollar. The other key component and value of a voluntary disclosure is usually you're going to get abatement of the penalties. And I say usually, you will get abatement of the penalties unless in some states, if you've collected tax and failed to remit it, they may impose a small penalty on those amounts that were collected and not remitted. And lastly, under the voluntary disclosure agreement, you will have an interest component. The states will apply they all have different interest rates, but there will be an interest component that you have to pay. So when we look at the register and file prior periods, it kind of looks and feels a little bit like a voluntary disclosure agreement. I think the key difference here would be the voluntary disclosure agreement usually is a larger, longer period of time. So if I only had to go back a month or 2 months, I might select the option 2 to register and file prior period returns. But if I've got 6 or more months worth of prior period activities I've got to disclose and I have to mitigate it, I'm probably going to go down the voluntary disclosure path. Now, another factor in this voluntary disclosure agreement option is that you can't have been notified or contacted by the state in relation to this tax type. You have to be clean to the state. The state can't really know that you exist in a way that you would have this liability. The voluntary disclosure agreement process is a sound process. It's more commonly executed when companies are either preparing themselves for due diligence to sell the business, or due diligence has been done by a buyer and the buyer demands that voluntary disclosure agreements be executed. Nobody wants to inherit your sales tax liabilities. So those are the common scenarios when the VDA might apply.
Let's kind of segue into the next piece here in terms of setting up a tax calculation process. And a lot of times when we're talking with companies, this is often very sequential in terms of kind of a step-by-step process of let's look at the nexus and let's look at the taxability of the revenue streams and let's quantify the exposure and let's try to figure out the best way to come into compliance. And Jeff had just talked about some of those options. But at the same time, in parallel, we also need to be thinking about, well, if we're going to register and we're going to start charging and collecting and remitting sales tax, we have to have some type of process to do that. And so that's what this next piece is really going to be talking about. I like to think about this and consider that in order to calculate the correct tax, and this is an oversimplification, there's really three aspects that you need to know. And we've talked about at least two of these three already, but you need to know the situsing. So what is the jurisdiction in which the taxable event is occurring? You need to know the taxability of that revenue stream in that specific jurisdiction, and you need to know what the tax rate is. If you know those three things, then you're going to be able to very adequately apply sales tax to those transactions. So when we look at this, and this references invoicing, but this would be the same for kind of an e-commerce site as well. There are multiple options. There's options within those accounting systems, within the e-commerce systems as well. Shopify is an example of one of those e-commerce systems. They had some fairly rudimentary sales tax capabilities previously, but then earlier this year they came out with a new sales tax program within Shopify that enhanced the ability to charge sales tax natively within their solution. So there's always an option of just leveraging the existing functionality of that ERP system or of that e-com system. For other scenarios where perhaps we're not necessarily happy with the functionality within the accounting or e-commerce system, but we are pretty certain of what the taxability is of the revenue streams. This might be a scenario where you're selling tangible personal property where it's going to be subject to tax in every jurisdiction. It may be very sufficient just to buy some type of tax rate subscription. So there's a lot of options out there in terms of being able to subscribe to companies that either provide a tax table, update it monthly that you can feed into your accounting system, or even a live API call to get that current tax rate applied. We've done a lot of work in the past with Zip to Tax as an option from a tax rate subscription perspective. And then probably what some of you are familiar with are some of these third-party tax calc engines. Sometimes they're referred to as plugins. You've probably heard of SureTax from Wolters Kluwer or Avatax from Avalara. Thomson Reuters has their OneSource product, Vertex. These are all software applications that integrate with the accounting system to apply the correct sales tax. So they take into account the situs, the taxability, and the tax rate to calculate the sales tax in a more automated type of fashion. When we start looking at, what is the best option here for customers, a lot of times it really depends on the volume of invoicing and also the geographic footprint of that customer. Think about it from the perspective of if we're selling in a single state, maybe that state has a single tax rate for that one state, and you're selling tangible personal property. That's a pretty easy scenario to solve for, where I think any accounting system could manage that simplicity for a client. But then we start looking at scenarios where maybe you're selling into multiple states, you're sending out hundreds of invoices a month, you have a mix of taxable, non-taxable products and services. That starts to get pretty complicated to try to figure out how to manage that tax application, and a tax calculation solution becomes much more effective. A lot of times we see companies that are selling SaaS, for example, on a nationwide basis, or we do a lot of work in the telecommunications space where these tax calc engines are really critical. So it's a question of geographic footprint, complexity of the taxability, and then just the volume of invoices that you have to manage that kind of points in one direction or the other. If we start looking at the tax calculation systems, a lot of times we're really looking at trying to find what systems integrate best with the accounting system that's already in place. So if you're looking at or working within NetSuite, for example, that might drive you to one type of tax calc engine. If you're working within QuickBooks Online, that might drive you to another tax calculation system as well. So a few different variables at play there. Something else to consider when you're setting up this tax calculation process is whether or not you could have exempt customers. And the exempt customers could fall into a couple of categories. The most common that we think about are resale exemptions, where you're selling something to a company that is then taking that product and selling it to someone else. The tax should be exempt when you sell it to your customer, and then your customer would apply tax when they sell it to their customer. So those resale exemption certificates are pretty common. There are other types of exemption certificates, probably too numerous to count, but a lot of times we see those for different government entities. We see manufacturing exemptions as well. And depending on the volume of these, again, it might be something that you can manage fairly manually. I talked with a company earlier this morning, and they were setting up an e-commerce solution and needed to be able to apply exemptions in real time. And the only way to really do that is you really need some type of exemption certificate management software plugged into the e-commerce solution. And there are options available to help facilitate that kind of real-time gathering and validation of exemption certificates. In other scenarios, you might have you might be setting up customers on a monthly basis, and maybe you're only setting up a handful of customers each month, and only some subset of those customers are exempt. That's a much more manageable process to do without any additional software. So that's really what we're trying to do here is figure out what's the most optimal way of applying the sales tax to the transactions, but also kind of keeping an eye on the fact that once we calculate the sales tax, we have to report it. And that's really the last bullet point here in terms of just making sure you've got kind of an eye towards what data do we need to capture, what data do we need for effective reporting. The tax calculation solutions are going to essentially capture all of that necessary data themselves. If you're managing this within your accounting system, depending on how your GL is set up, you may or may not have the requisite fields to account for all of the different tax types and the different data elements that you might need to file those tax returns at a later date.
So as Brian talked about the tax calculation options, I think it's always important to spend a good bit of time on that section because that is where the rubber meets the road. From my perspective on the consulting side, it's about calculating the tax correctly. There's certainly a number of factors that go into tax compliance. Where do I have to comply? How do I comply from the standpoint of applying tax to my transactions? And how do I comply with the jurisdiction? How do I file and report the tax to the jurisdiction? Those are the kind of three primary components. And those factors, those components exist for companies that might not currently have a sales tax system or maybe not a robust sales tax system. A lot of our clients are operating in a fashion that they're growing. And as they grow, they're having to take a look at their sales tax compliance plan continuously, at least every 3 months, maybe 6 months. And they have to kind of walk through this sort of test and ask these questions. Evaluate where they have nexus. Have they expanded their nexus footprint? What is their product from a taxability perspective? Does it meet the criteria that would require them to comply? And is their activity on the taxable side material? One of the things we didn't dive into in this presentation, but we talked about in our last one, was the fact that I might create nexus and I might even create economic nexus, meaning I might have material revenue over $100,000 in a given state during a 12-month period. But 90% of my revenue might be exempt and only 10% of my revenue is taxable. So maybe I only have $11,000 in taxable revenue. That might not be material for me to invest in any sort of compliance activity. But as Brian discussed around tax calculation, once you've established a tax calculation protocol, to the extent you've made an investment, particularly if it's a systematic or a software-based solution, now you're better equipped to make the decisions as to when to register, where to register, and the materiality starts to change a little bit because your cost of compliance is now spread out over a single platform of tax calculation. As is usual, whether or not you decide to register, exemption certificates can be a critical element of your compliance, meaning you might find that you have reached that threshold economically, but the majority of your sales are to exempt entities, might be for resale. You might decide not to register, but even if you don't register, you still have to get those exemption certificates from your customers. Otherwise, you might as well assume all of your sales are taxable. So despite you're not being registered for sales tax purposes, you're still in a position to request and receive exemption certificates and maintain those on file. Once you have made the decision to register, there's a few pieces to that process that we always like to highlight for you. Some states, it's a fairly straightforward process. You answer a few questions, provide some critical information about the company, and you're registered. However, all the registrations will have different challenges. In some states, you've got local reporting requirements. Some of those locals might be administered by the state, like here in Georgia. Georgia administers all of the county taxes across the state that are collected in addition to the state tax. There are states like Colorado where there's about 70 plus home rule jurisdictions, we refer to them as. Home rule jurisdiction just refers to a city that has established its own sales tax, its own ordinances, and has its own rules of taxability as well as administration. So you may have a requirement to register not just at the state level, but also at the local level. This is true in states like Colorado, Alabama, and Louisiana primarily. Whenever we go to register, you're going to have a question on the registration application that asks, when was your first taxable sale, or when did you establish business in the state? That's the effective date of your registration. Everyone sweats when they get to this question because most companies we work with probably have established nexus in some prior period. They probably would acknowledge that, yeah, they should have registered a year ago, but they didn't. They've been sort of waiting to see if the market in that state was going to continue to be fruitful for them, and now they figured out it is, but this question just sticks them. I just will tell you that, it's important to be honest. We're not asking anyone not to be honest in their application process, but recognize, again, going back to something I said earlier, voluntary compliance is what the states are based upon. I had a conversation with the state of Pennsylvania a couple months now ago. I was talking with two assistant secretaries of revenue there, and I shared with them that there's common scenarios in our business model where we'll face this question for clients that had Nexus previously. They haven't charged or collected tax, and they're not in a position to mitigate that prior period liability if they were to be assessed. And so if they were to put the true effective date, they would just bury their head in the sand and say, I'm just not going to do anything. And I said, we want those companies to be compliant. The sooner they can get in a position of collecting and remitting that tax to the state, we believe is in the best interest of everybody involved. And the state agreed. They did not say to me, you can put whatever date you want on the effective date. They just gave me a shake of the head up and down that kind of acknowledged the reality of the space that we play in. And that's just one of them. Tax types. You got to be careful when you go to register that you understand truly your overall business activity and how that business activity is taxed in that state. There are different tax types that might apply to different types of businesses. For example, in Florida, if you're in a telecommunications services business, you're not registering necessarily for sales tax purposes, although you may also need that, but you're going to have to register for Florida's CST, communication services tax purposes. Totally different level of taxation, different compliance responsibility. Another thing that really irks our clients, particularly because we're usually the the entity that's registering on behalf of our clients is we're going to ask for an officer's name and social security number. The state wants to have a hook into somebody that's got some level of responsibility once the tax is collected to get it remitted to the state. Again, you're a taxpayer that has an obligation to comply with these rules, but you're also an administrator or an agent on behalf of the state in the collection and remittance process. If you build a company and start to apply tax to all your invoices, collect that tax, and find yourself cash flow short such that you pay your payroll with those taxes you collected, you're in trouble. And so you might go bankrupt as a company, but the state is still going to go to that officer and hold them responsible personally for those taxes under those conditions. Last thing I'll mention is whenever you're establishing yourself as a registered taxpayer in a state, recognize that a lot of the communication with the states, and particularly how you're filing with the state, is going to happen electronically. It's all going to happen through a state-managed portal. You're going to have login credentials. There'll likely be some level of dual authentication, which means you're going to have an administrator, somebody that has the responsibility for authenticating other users within the business. But the other critical component is that person, if they should leave, and you're not really up to speed on where they have logins and where they have administrative authority, you're going to find it very challenging and very difficult to get yourself back into compliance, to get access to those accounts. It's just a challenge. It's more of a headache than anything else, but just recognize there's a little bit of administration that goes on with these filings. And lastly, again, just like there's a number of options around tax calculation, there's also a number of options around filing and remittance. And we'll talk a little bit about those here in just a little bit. As we get into the space where we've passed the registration, we've passed the calculation methodologies, we've got a process in place, we now have to get to that place where we can execute. You're going to have to file returns in the sales tax arena anywhere from monthly, frequently, or quarterly, potentially semi-annually, maybe even annually. Most taxpayers are either monthly or quarterly. And essentially what you're going to do is you're going to go about your business collecting taxes during the course of a month. And then usually by about the 20th of the following month, you'll be obligated to file a return and pay the taxes you've collected. So it's important, as Brian said earlier, to have as formal a process within your tax calculation system on the back end, capturing the data in a summary fashion, as it is complying or calculating and applying the tax to the invoice. So make sure you understand what the reporting functionality is within your tax calculation process. Establish a formal tax calendar that's visible to the department responsible, meaning understand where you're registered, understand what your registration or your account numbers are, what is your filing frequency. Have that all managed in a centralized location. This is just a restatement that you've potentially got both a state level reporting requirement as well as a local reporting requirement. Again, those should be part of your tax calendar. If you've got some cities you're registered in, those should be treated similarly to a state. Your filing options, there's a number of different ways to go about reporting. The majority of the states now are requiring online reporting, so you are going to generally file online. Whether or not you file online yourself or through a third party, there are some options in that regard. But more often than not, if you try to file a paper return, the states are not, I won't say they're going to deny it across the board, but there are states like Arizona will refuse a paper return, a paper check. So just be aware of some of those requirements. Payment options can be, again, because we're talking about primarily electronic funding, these are generally going to be ACH debit type transactions. Be aware when you're registering with the Departments of Revenue, you could be overlapping with payroll taxes or with income taxes. And so those payment options, they may be established within your account online such that the state could maybe pull money in for other reasons. Maybe they believe you're deficient on income tax. they may take that payment information you've uploaded or that you've populated in their system and actually pull a payment or pull cash out of your account to satisfy what they believe to be an obligation of the state. And finally, notice management. Notices are correspondence you're going to receive from jurisdictions. It's going to happen. It happens just about everywhere. It can come in the form of mail through the U.S. Postal Service, and in a lot of states, they're now leveraging the online portals, the technology, and so you're getting an alert. And some of those alerts have different sort of escalation points. Sometimes you don't even get any type of alert other than the fact when you log in to file your return, you might see that there's a message that's somewhere on that page that you've logged into. Pay attention to that. Some notices have deadlines, and some of those deadlines are such that if you don't respond timely, you are stuck with whatever liability they've assessed. So notice management, having a forethought to how you're going to manage that and making that a formal part of your process is very important.
Yeah, Jeff, I'll just make a quick comment on the notice management and maybe even tie it back to some of the tax calculation options that we mentioned earlier in the discussion, where there's some of these solutions out there that have kind of an automated or auto file type of scenario where the returns get filed in an automated fashion, and no one's really looking out for these notices. Jeff just mentioned that they're either going to be a paper notice that's going to come to you and you got to do something with it, or as he mentioned as well, becoming more and more frequent, those notices are posted to the e-file site, and you got to be looking at that, managing that, making sure that you're responding to those notices, even if you've got an auto file solution in place. So our last slide here, why would you potentially consider outsourcing the sales tax? And as I was thinking about this, maybe the question is, why would you consider doing it in-house? It's a very complicated and sometimes overwhelming process, and very few of the businesses that we tend to work with, at least in this small mid-market business segment, very few of them have any internal sales tax resources. If you're like most of the companies we talk to, there may be no tax resources, certainly not sales tax resources, and this is usually managed by a controller, VP of finance, or CFO that just has a lot of other things to deal with and worry about. But a lot of times what we hear from our clients in terms of why they're considering outsourcing, they've had one of these types of events here that we have on the screen in terms of, maybe they've operated in 1 or 2 or 3 states, and now they've realized through Wayfair that they've got an obligation in 20 states, and they've got this expanding nexus footprint, and they just don't have any way to manage that effectively themselves any longer. Or maybe they've had someone managing it quite effectively internally, but then that person either gets promoted up into the business into another division or another role, or maybe they just leave the company, and now we've got this hole to fill in terms of how are we going to manage the sales tax piece without turnover, and that becomes another driver for looking at outsourcing as an option. Every once in a while, we see these, an adverse audit popped up kind of unexpectedly. I guess you wouldn't have it would have to be unexpected if it were adverse. But you have a bad audit result, and it kind of makes you question, well, maybe we've got issues in other states. Maybe we should look at this, and maybe we should outsource this. Also seen scenarios where companies are trying to build scale within their organization. So maybe they've got a process that works okay, but they're changing the way they do business, and maybe they're looking at a series of acquisitions to add to their business. And before they undertake these acquisitions, they need to make sure that this process is shored up and maybe have an outside resource manage it for them and build that scale into the organization so that they're able to effectively manage and absorb those acquisitions. So a lot of different reasons. These are probably some of the more common scenarios that we face. Thank you.
Thank you, everyone.
This has been It Depends, with another episode explaining the complexities surrounding sales and use tax. We'll see you next time.